If you've spent any time in the ETA or entrepreneurship through acquisition world, you've heard people throw around some terms like SDE, LOI, seller note, Q of E, usually with the confidence of someone who assumes you already know. And most of that vocabulary, for the most part, for normal business people, normal entrepreneurs that haven't gotten into the business buying world yet, probably don't make much sense or aren't that familiar. So in this solo episode, what I'm going to do is I'm going to break down some of these terms. That way, when you're listening to our interviews, you have a basic foundation or understanding so that you know exactly what's going on when someone mentions Q of E, LOI, SDE, EBITDA, and so on and so forth. So firstly, let's kick off with the basics. ETA stands for entrepreneurship through acquisition, and that's this whole category. So instead of starting a business from zero, it's buying one that already has customers, revenue, staff, and then you just run it. The whole premise here is that operating an existing business is fundamentally different in terms of risk than creating one. So you're taking execution risk. How well can I run this business rather than does anyone actually want my product? One of the biggest challenges when it comes to starting a business is the costly, both in terms of effort and financial cost of finding product market fit and determining whether or not anyone actually wants your product. Secondly, search fund. So a search fund is a very specific structure that came out of Stanford in the mid-80s, where basically investors first find a searcher, a person, an entrepreneur who wants to go and buy a business, and they back that searcher. They give him salary and expenses for about 2 years while they look for a business to buy. And then when they finally buy one, those investors get the first right to invest in that acquisition, obviously on quite good terms because they've been paying for the searcher this whole time and they're taking on all the risk of the searcher perhaps not finding a business. Generally, and as we broke down in the first episode of Deals Down Under with Pete Seligman, the structure in Australia at least is the searcher gets 8.33% of equity on acquisition. They get 8.33% on exit. So if the business is sold or there's a major refinancing or liquidity event, and then they get 8.33% based on a specific return target for the investor. So they end up with 25% of the business all up. It's not the only way to structure it. There are certainly ways, and kind of what I do, at least with my search and the investors that I've dealt with and funders that I've dealt with. And I have had deals funded, so I know this works for sure. But my approach is generally to end up with majority ownership and control of the business. And we'll talk about how to actually do that at a later stage as well. So the search fund is not the only way to do it. But for many first-time entrepreneurs who perhaps have, gotten a commerce degree, an MBA, or they've had some corporate experience, and then they want to go down this path, but they don't want to risk signing, say, a personal guarantee, or they don't want to risk putting their own capital, having to put their own money into their acquisition, then they can do it this way. And obviously the rewards are commensurate to the risk. Self-funded search, conversely to a search fund, is where you fund your own search. So you've got no investors and no obligations at the beginning. There's no clock ticking. And obviously in that instance where the risk is higher, like we said, you keep dramatically more equity. So that's what I've been doing. And like I said, I've had deals funded in this way. I'm obviously doing a couple of things different, even to a traditional self-funded search, which we'll get into at another stage. But the challenge with self-funded search is you have no salary and no institutional backing when you're negotiating. You need to find a way to make business brokers and sellers to take you seriously without necessarily being able to provide them with proof of funds or investors behind you. Then there's another version called the independent sponsor. And so that's where you go out and find a deal and then raise the equity for that specific transaction from the investors. So there's no committed fund. You're not being paid to search, and your leverage comes from having the deal in hand that investors want to get involved in. So you bring a good deal to investors and then they want to invest. And this kind of sits somewhere between self-funded search and the search fund. Finally, we have the searcher. So that's the person that's actually buying the business. Sometimes it's called an acquisition entrepreneur, sometimes a search fund principal, but it's basically the person that goes out, finds, and potentially, in most cases, then operates the business that they buy. There are some cases where that doesn't happen, but that's the exception, not the rule. So for section 2, we're going to talk about how businesses get valued. So this is all the vocabulary regarding business valuation, income, profitability, a little bit more technical. First off is seller discretionary earnings. The easiest way to think about seller discretionary earnings, or SDE, is basically everything that the business would give you to an owner as an owner if you owned 100% of the business. So what I mean by that is you go, you buy a business, that business is generating for the previous owner, say $200,000 in profit. He's also paying himself a salary of $100,000. $100,000, then the total seller discretionary earnings is $300,000. So this is the net profit, adding back the owner's salary, the owner's personal expenses that ran through the business, also interest, tax, depreciation, and amortization, and any once-off costs that won't reoccur. So just worth noting that we always add back the tax when we're looking at these as well, because obviously if you're buying the business, you might buy it under a different tax structure or under different circumstances, and so your tax will be different. So when we're comparing different businesses and their profitability, we add the tax because tax treatment for all these businesses is different, and we want to make sure that we're comparing like for like. Next after SDE is EBITDA, EBITDA. That's one that you might have heard of. It stands for earnings before interest, tax, depreciation, and amortization. So the key difference here is that it doesn't add back the owner's salary, because we're assuming in this instance, what is it going to cost for the business to run independently? Meaning if I buy this business and I put a manager in place, or I have a professional management team who are running the business, I should be able to be almost entirely hands-off. Being entirely hands-off and passive income is obviously a pipe dream, and it's something that the Cody Sanchez's speak of, but it isn't real in reality. In principle, the EBITDA is the profitability of the business once there is a manager in place, so that if we're not running the business, what do we end up with at the end of the day? That's generally the one that the businesses are valued on when we're talking multiples. Now, when you're dealing on the smaller side of businesses under $1 million in annual profit, what you'll find is the business brokers typically add back the salary and give you an SDE, the seller discretionary earnings that we talked about. Another term that I've heard for this is P-EBITDA, which is personal earnings before interest, tax, and depreciation, amortization. And that's just the seller discretionary earnings. When you get bigger in size, I think $1 million plus, that's when ultimately businesses are more often run under management. And that's why we look at the EBITDA number. Now, Addbacks. Now, the term Addbacks refers to the adjustments and the expenses that are in the business's accounts, which might be family members on payroll. It might be a personal vehicle, a holiday that they've paid through the business, stuff that we add back into the EBITDA or the SDE, so that we can get an idea of, if I was to buy this business, obviously I'm not going to be paying for Joe, the previous owner's future trips to Fiji and their family car. So let me add those back so I can get an exact idea or understanding of what the business is going to be generating for me as a new buyer. So that's what Addbacks are. Multiple. The multiple is the number you multiply the earnings by to get the price. So Australian small businesses generally run lower than comparable US deals. And the reason for that primarily, or in my view, is because the Americans have what's called an SBA loan, which is a government-backed loan for small businesses. It stands for Small Business Administration. That's actually the reason why this whole podcast and channel started, was because a lot of the content is based around people going and taking out SBA loans, which are very, very easy to get and require a very small deposit in America, which makes buying a business significantly different to in Australia, where in Australia, you're going to more than likely have to work with investors, because the banks are likely to only give you, say, 50 or 60% of the purchase price. And that's, as for a little bit of a tangent, why the podcast is here, and why we create this content for you guys, because that one little change with the SBA is what creates all the difference. So that's a bonus term. But the multiple is the multiple that we pay on the earnings to get the purchase price, and the multiple is typically higher in the US because of that SBA making it easier and providing more cash to buy businesses. Enterprise value versus equity value. Now, enterprise value is what the business is worth as an operating entity, independent of how it's financed. So that's just the earnings times the multiple. So let's say you've got $1 million earnings business and it's valued at a multiple of 4 times, then the enterprise value would be $4 million. Now, that business might be carrying $2 million worth of debt. Equity is equal to the enterprise value minus debt as a general rule of thumb, which means the equity is, in this case, $4 million minus $2 million. The equity value is $2 million. And so that's what 100% of the shares in the business is worth, $2 million, because think about it. If we were to sell the business for $4 million tomorrow, we would have to pay off our debt, which brings us back to the $2 million number. Fairly straightforward. That's an oversimplification, but all you need to know for the case here. Asset sale versus share sale. So that's two different ways to structure the purchase of a business. This is something you get your lawyer to help you with, but at a very high level, an asset sale is where you set up a new entity, a new company structure, and you acquire the assets of the old business and move them into that new entity. And the reason why we do that is so that we can take all the customers, the contracts, the licenses, the employees, the equipment, all of the assets of the business can go into a new structure while we leave the liabilities behind. Because sometimes when people sell businesses, they don't tell you, in fact, in most instances, they don't tell you everything about the business. It may be that they have undisclosed tax liabilities, they haven't paid their taxes in a little while, or they might have a grumpy employee that is taking them to Fair Work, that's taking them to court. We don't want to carry any of that stuff with us if possible. And we want the business to be working for us from today moving forward, where we're not having to be totally concerned about the stuff in the past. And so an asset sale and setting up a new entity is just one way of doing that. Conversely, a share sale is where we just buy the existing entity. So instead of doing an asset transfer from an old company into a new company that you incorporate, you just buy the shares of that old company. Very straightforward. This is something that you'd work with an advisor when you get closer to doing a deal. Working capital adjustment. So that is the mechanism that ensures the business that you buy comes with enough cash inside of the business, as well as stock and receivables to actually operate. So if you think about it, if you buy a business and there's $0 in the bank, perhaps 2 weeks from now, or depending on when your pay cycle is, you might have to pay $50,000, $100,000, $200,000 to your employees for their payroll. And you want to make sure that that money is in the business when you buy it, so that you don't have to then all of a sudden have to find $200,000 to pay your payroll. Same deal with other commitments like payments to your suppliers and whatnot, or marketing, or whatever the case may be. Your general operating expenses, we just want to make sure that there's enough money in the business in order to support that until the revenue starts coming in. Now, moving on to part 3, we're going to talk about the deal process. So you might have heard me talk about proprietary search versus a brokered search. Proprietary deal flow is when you reach out to sellers directly, and brokered means you reach out to business brokers who give you a list of their deals, and then you choose out of the list of their deals based on which ones you want to negotiate for. So that's proprietary versus brokered search. An IM is an information memorandum. That's the package that brokers or sell-side advisors send out to potential buyers that includes all of the high-level information on the business. Then we have an NDA. An NDA is a non-disclosure agreement. It basically just says you're not allowed to share certain details. An LOI, a letter of intent. Sometimes in Australia, this is called a heads of terms or heads of agreement, HOA, I've heard. And that letter of intent basically is a pre-agreement before you sign the final definitive documentation that actually signs the business over to you. So once you've arrived at a agreed price and some headline terms with the seller, you sign this LOI or HOA, and that says, okay, we're doing a deal. It's happening now. Now we're going to go to the lawyers and the accountants, and they're going to do the actual administrative work for the deal in order to officiate the deal. Due diligence is the stage between signing the LOI and the definitive agreement. So that's the stage where you've made an agreement with the seller, but the business hasn't been transferred yet. And in that time, you're verifying that everything that they've told you is true, and that it is in fact a business that you want to buy, and that it doesn't have any of those undisclosed liabilities that we talked about earlier. A Q of E is quality of earnings. That's a report that we go and get from accountants. It's a deep dive on the business that tells you how good the business's earnings are, whether or not they're sustainable, and basically what an audit firm or an accounting firm thinks of these. I like to get these during the DD stage as quickly as possible so that we can take them straight to the banks, because the banks are going to trust a large accounting firm's Q of E more than they're going to trust you, obviously. So when you come and say to a bank, hey, we're generating $1 million in profit, they're going to want to know what that is based on. And that's where the Q of E report comes in. Now, on to part 4, funding the deal. The first one I want to kick off with is the SBA loan, which you might hear be thrown around on the podcast, but it's not a funding structure that any of our guests use. And again, that is why we created this podcast. The SBA stands for Small Business Administration once again. And that's when the government backs these loans for entrepreneurs in the US that are going to buy businesses. It doesn't necessarily need to be to buy businesses, but in the context of what what we're talking about. It's for buying businesses, and the terms are very favorable. It's, generally 10 years, sometimes up to 20 years if there's property involved, and very small deposits. And that's why they can do bigger deals and the multiples are driven up in the US. Now, I've got an earnout. That's when you pay part of the purchase price later on and not on day one, contingent to the business hitting certain targets that you've agreed on. So it bridges basically valuation gaps where the seller says, I don't want $1 million for the business. I think it's worth 1.5 and you only want to pay $1 million. Then you say, okay, well, if you continue to grow the business a little bit to the point where it justifies us paying 1.5, then we'll pay you the extra 500K. Vendor finance or a seller note is when you pay part of the purchase price over time to the seller instead of paying it back to, say, a bank. And it's basically just where the seller is acting as the bank. And that is typical in a lot of deals. It's good to have up to 10, 20% is kind of typically what you would see. Certainly has been done with far, far more, but sellers generally don't like having most of the deal be a seller note. Equity is your own money and money from investors that come into the deal. So that's stuff that's not debt. It doesn't have a strict repayment schedule. Debt service coverage is the ratio of cash available for the debt repayments. So that's basically the amount of money that you have coming in divided by the amount of money that goes back out to debt. So if you have $1.5 million in profit per year and the debt repayments every year are $1 million, then your debt service coverage ratio is 1.5 times. Roll up, you might have heard, that's when you buy a lot of companies, smaller businesses, and turn them into one large company. The small companies are almost always very closely related. So think you might buy 10 different vet clinics, 10 different dental practices, 10 different swim schools, and then they're all run by one head office being you as the operator. The reason why people do this is because you can buy them at a low multiple. So the smaller businesses might be worth 2 or 3 times. So a business generating 500K a year in income, in SDE or EBITDA or whatever the case may be, we know what those are now, might be worth $1 million. We buy 10 of those. Now we're generating $5 million. That profit, because it's so much larger, is worth so much more. And we'll talk about that, why that is at a later stage as well. But because that profit is worth so much more to a new buyer, then we might be able to sell it for 6 times. So we've got these 5 businesses for 500K each. We've bought them at profit. We've bought them for $1 million each. That's a total purchase price of $5 million. We can now sell our 500K times 5 is 2.5 million at, say, 8 times. So the business is now worth 2.5 times 8, obviously a much, much larger number. And there's some arbitrary value that we generate, or arbitrage value that we generate rather in there. So some key closing takeaways. 1, SDE is seller discretionary earnings. EBITDA is earnings before interest, tax, depreciation, and amortization. SDE is everything that goes to the new owner if they're operating the business, and EBITDA is the earnings if the business is under management. Key takeaway 2, SBA being small business administration. The gap that is created in Australia as a result of the lack of SBA is why we can't just copy American deal structures. And that doesn't go for just Australia. That's everyone basically outside of the US. And so that's what we talk about a lot on this show. And 3, the LOI is the letter of intent. And that's where the deal gets negotiated and keeps our key terms. So if you're new to Deals Down Under, this show exists because almost all of the good ETA content assumes that you're American, that you're buying an American business with an American SBA loan. And that's certainly not the case in Australia and not for most of the world. So go subscribe to the channel, go watch some of our interviews, and you'll see exactly how these deals are done in Australia. And we're looking forward to helping you on your search.